welcome on board Gautam Duggad from Motilal Oswal Securities and chat about what he's making off the market. Gautam, hi, good morning. Just looking at ACC's numbers, the fact that the crude spiked, that crude is at a 6-month high, definitely has weighed in on the margins for ACC. Do you think that could be the trend across the cement industry? Because you've got Ultratech reporting its numbers today.
Hi Aisha, good morning. Yes, SSC's numbers were quite bad. We were expecting an EBITDA per ton of around 840. I think they've delivered 700, and we also cut our estimates by around 19%. The problem with this sector is there is no secular trend in this sector. It's a cyclical sector, and the fortunes of this sector depends on volumes, price, and cost. And at any given point of time, if you see in the last 3-4 years, 2 out of those 3 parameters are not in its favor. So the predictability of earnings has taken a big hit, and I think this trend should percolate to other companies as well. Obviously, last quarter also we had seen some divergent trends within the cement sector as a whole, but also need to cognize the fact that volume growth on a YY basis for the sector is also tapering down. If you remember, first quarter, second, third quarter also, we had double-digit volume growth for our cement universe. This quarter, we are expecting a 6% growth only on volume terms, but realization is slightly better on a YY basis, 3-4% growth. And we had thought that sequentially, because the cost pressure has come off, whether it was pet coke or some of the other freight cost-related elements, maybe there would be respite on the EBITDA. But the first result which has come in from the sector is not indicating that trend. So we'll have to wait and watch. Ultratech, we are anyways expecting a very flattish number, because the interest and depreciation cost for the acquisition that they have done. So overall, would remain very watchful for some of these trends emerging. And as you rightly pointed out, crude at 74 doesn't help the cost for the sector.
Will the outperformance this earnings season remain with the financials, or do you think there is a fair chance that there could be some other dark horses too?
Oh, absolutely. This is a quarter of financials. Aisha, if I were to just point out our numbers, we're expecting a 15% Nifty earnings growth, but you take out the 3 corporate banks, the growth is a decline of 3% for Nifty. For our broader universe of Motilal Oswal coverage, we are expecting a 29% growth. But again, if you take out PSU banks, which are, where we are seeing a swing from a loss of 24,000 odd crore in the base quarter to a profit of 5,000 odd crore, the growth is absolutely flat. So this is a quarter of financials. Again, last quarter was also same. If I recall, in the third quarter FY19 also, if you see the Nifty earnings growth of somewhere around 8 to 9%, and X of those 3 banks, the growth is 0%. So clearly FY20 for the markets, for Nifty, it is going to be led by financials. We are expecting that the incremental growth, 60% of that will be contributed by BFSI. So for whatever reason, if there are big changes in the financials numbers, either on the upside or on the downside, it will have a disproportionate impact on the broader market earnings. It is a very crucial part of FY20 earnings recovery, because X of those banks, Nifty earnings growth that we're expecting for FY20 is just 13-14%, which in itself is a very healthy number if you compare with the trend of last 4 or 5 years. But the expected reported growth of 24% is by and large being driven by the corporate banks, which is where our portfolios are overweight as well for the last 1 year now.
On corporate banks, that you're also looking at PSUs closely, Gautam. Tell us what you're anticipating there and why you feel we could see earnings growth, being led also by that pocket.
So as far as PSU is concerned, for our portfolio, we just have SBI, where we have actually increased the weightage by 100 basis points this quarter. For X of SBI, rest of the PSU banks, things are going to be extremely volatile. Specifically pertaining to the quarter, you are sitting on an extremely benign base, because in the base quarter, SBI had reported a 7,000-8,000 crores of loss. PNB had reported a 13,000 crores of loss, and I think Bob had also reported a loss of 3,000 crores. For this quarter, our estimate is put together around 5,000 crores of profit amongst these 3-4 banks, which is sequentially flat, but the YY comparison looks very good. Going forward, you will still have to be very watchful on the asset quality trends, plus the capitalization levels and how the growth, on the loan, credit side that we are getting, because the fact remains that post the NBFC crisis in September, we have seen shifting in market share away from NBFC to the banks, and the early results which have come in from the private banks side, whether it is HDFC Bank or DCB, AU, RBL, the numbers are very fantastic for all the 4 banks which have reported, be it credit quality, be it top line growth, be it margins. So clearly the market share shift from NBFC incrementally towards the bank is underway. I think the early beneficiary obviously will be the private banks, given the capitalization levels which are there and overall liquidity situation also in the market. From a PSU bank point of view, we are clearly more biased towards SBI. We also had from a trade perspective, last quarter we had added PNB, which still remains part of the portfolio, but that was more a valuation call. As far as fundamental structural earnings trajectory is concerned, one will have to see how the overall asset quality trend pans out for the next 2 or 3 quarters, because there are incrementally new issues which keep coming to the fore.
Let's talk about sectors that you would avoid. As of now, it's cement as well as the pharma space, and you also think that oil and gas looks bleak fundamentally. Can you elaborate?
Yeah, so if I recall FY 17, 18, and large part of first of FY 19, the earnings growth, whatever extent we have got, was by and large led by 2 sectors, which is commodity, metals and oil and gas. And incrementally, since the second quarter of FY 19, the growth pattern has shifted from global cyclicals to the domestic cyclicals, and domestic cyclicals is nothing but the banks which we discussed a minute back. As far as global cyclicals are concerned, metals we're clearly seeing, and we've been highlighting this for almost a year now, that second half of FY 19 is where the earnings trajectory starts moderating, and FY 20 is where you get the first year of earnings decline vis-a-vis the performance of last 3 years. Similarly, for oil and gas, for the quarter specifically, we're expecting a very flat growth, largely because of the decline that we are expecting in OMCs. Last quarter OMCs had completely gone down the drain with a 90% YY profit decline. This quarter, while YY comparison looks sequentially slightly better, but at 25-30% decline, it's still a meaningful decline, I would reckon. And the other stocks where we are seeing growth, whether it is Reliance or ONGC, there the valuations remain crippled because of the various policy-related issues as far as the upstream oil companies are concerned. And now at crude at 74-75, there is always a cap on the the valuation expansion that one can expect. So they remain a value pack. Their PE ratios are not very expensive, but then that's the band that they have traded in the past. And with incrementally the earnings trajectory moderating, it doesn't help the cost for the sector. So that is where we've been underweight for some time now, and that underweight position stays. As far as pharma is concerned, clearly, I mean, this is a sector which has not seen any earnings growth for the last 4 or 5 years. Maybe few companies here and there in that broader pack of 25 stocks that we cover will have good quarter, especially the mid caps. But for large caps, the earnings fortune still remains very, very subdued, even on a low base. If I were to give you statistics, 5 years back, the earnings pool for our pharma universe was at around 17,000-18,000 crores. After 5 years, it is at 21,000 crores. So we've hardly seen any growth. And incrementally, the return ratios for these companies in the pharma sector have been in the 14-15% band. So while they're called as defensive, but their return ratios are not defensive, their earnings predictability is not there, and at the margin, you're not seeing any meaningful improvement over there, whether it is related to the compliance-related requirements of US FDA or, for that matter, the pricing erosion. While the decline has stemmed, but you're not seeing any catalyst for an upside right now.
Okay, some of your top picks, Gautam, have been the likes of a Titan, Pidilite, even among some of the banks you mentioned. And these are names that have had, a really good run of late. Valuations now, I want to get your sense on them, and also wonder what you would do with some of these names at these levels, or what you would advise.
No, so some of these names have done exceedingly well, and when you look at companies from consumption space, whether it is a Titan or a Pidilite or a Hindustan Lever or a Britannia, you can't take a view on them from a one-year perspective, because these are very solid franchises where underlying trends are in their favor. For example, Titan is the biggest beneficiary of unorganized to organized. We've been liking this stock since 2016, and it was expensive even then. It is more expensive today, but the fact remains that in a 2 lakh crore jewelry market, the composition of the organized trade is still sub 20%. So the growth horizon for companies like Titan is very, it's a multi-year growth story. So do you want to take a 1 year forward PE call and sell it today and then regret later? The answer is obviously no. But These stocks can have a substantial period of time correction, be it 6 months, 12 months, nobody knows. But the strategy on such long-term structural stories is to buy and hold. So Pidilite has always looked expensive at any given point of time in the last 5 years. The fact remains the stock has still compounded pretty well. Same is the case with Hindustan Lever, also Britannia. So I recognize that the valuations are expensive on a 1 year forward basis. Possibly the stocks could have a time correction, and if monsoon is not favorable, maybe there could be a decline. But timing the stock is something which is very difficult in the consumption space. So we will have our 4 or 5 preferred bets, and that we will keep on holding. So that's the call on consumption. And on private banks, as you mentioned, we still see that the cycle has just begun. The new cycle has just begun, and there is a possibility of earnings upgrade happening in the next 1 or 2 years for a lot of these well-managed private corporate banks. In fact, for the last quarter, we had seen earnings upgrade for ICICI and Axis after a long time. We have not seen any earnings change in these banks, and incrementally the credit quality is improving. The guidance for ROEs is far stronger. You've seen the results of some of the mid-cap private sector bank also. So right now the cycle has just begun. While they have done well, but I think in a new up cycle, valuations do tend to overshoot. Just like in a down cycle, we have seen valuations undershoot for a fairly long period of time in 2016, 17 and 18. So we will remain biased towards private corporate banks at this stage. Within the retail space of the private banks, our preference still remains with HDFC Bank. So that's how we are positioned on consumption and private banks.
All right, let you go on that note, Gautam. Pleasure having you with us on board, sharing with us your overall market outlook. Meantime, it's quiet for the